This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to that chart deck. Listeners, you're going to find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you're not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Adam's picture that says, looking for the downloads. All right, Eric, let's cover crude oil, starting with that EIA inventory.
EIA reported a drawdown of 3.7 million barrels of crude oil. 970,000 barrels came out of Cushing, Oklahoma, but the big drawdowns were in finished products, with gasoline drawing down 4.1 million barrels and distillates drawing down 3.7 million barrels. U.S. production holding flat at 12.2 million barrels per day. We were previously living under the 100-day moving average, wondering if we'd ever cross above it again. Then suddenly we gapped and so far have stayed above the 100-day moving average, well above it, thanks to OPEC's surprise announcement of a production cut exceeding 1 million barrels per day. Now, a lot of people are celebrating, saying, okay, the bull market is finally on, but I'm expecting this gap to be filled. I think we're going to trade down to $75 before this is over, and maybe it is the beginning of the bull market, but I don't think it's time to rush in and buy up here above $80. I think it makes much more sense to wait and maybe buy the gap fill when it happens.
Yeah, Eric, I put up here on that chart just showing the volume profiling on page 2. What was really interesting about that OPEC news is it gapped through a major high volume price zone, and we're now several trading sessions into holding above there, which is generally very bullish. I think that if any consolidations here in crude oil that stay, maybe we could see a quick dip to 78 or something like that, but generally, so long as dips are being bought, this could have been the trend-changing moment in crude. Obviously, some overhead resistance along the January and February highs right here, but at this point, any one proper break above 82, 83 zone above, we could see $90 crude oil in a span of a month. We'll see how it plays out. Nonetheless, Eric, what's your thinking here on equities?
Well, as I said a few weeks ago, I am still leaning toward a rally up to 4309, which is the 61.8% fib retracement on the whole bear market. I would expect that to be followed by a rollover and then new lows on equities. But I really don't have any strong conviction on what happens next in the short term.
Yeah, Eric, that 4309 level that you're mentioning also corresponds with the August high and is certainly going to be a point where if the market is going to make one more push higher in the post-jobs number, that would be a very reasonable target. Nonetheless, let's talk about the actual levels. Nick, on that S&P 500, what are the levels you're watching from the options perspective?
Spot right now is 4090 or so as we speak, pre-market on Thursday. Right now, the call wall above is at 4150, put wall way out of the money at 3800 or so. The implied move for the April 21st OPEX, again, because we're recording on the expiration date for today on Thursday, is 110 points in either direction. So right now, we have an upper expected move of around 4,200 and a lower expected move of around 3,980. The key support areas right now are 4050. If you get below that, expect a fast move to 4,000 or so. And if we break 4,000 again, that's where you're probably going to see the VIX take off, and you're going to see a sharp move lower, perhaps. I'm inclined to think that we see a slow grind higher into the April OPEX, and then after the April OPEX, perhaps we see volatility pick up. But keep in mind, we have CPI numbers coming up as well, so that could change everything before the April OPEX. I'm slightly bullish for the next couple of weeks, but I'm bearish overall in the midterm.
Yeah, I have to agree with a lot of those things you're saying. Overall, obviously, the jobs numbers that are going to come out here going into the CPI are going to be important. But it's interesting that just around that April OPEX is also going to be where the pig in the python moment is for the earnings season, and we're going to really start to see the reactions as to whether or not corporate earnings are holding up. And so there's a lot of things going into the summer, kind of like that sell in May and go away period that could be challenging. But on the short term, so long as the market can get through a potentially weaker jobs number, then a retest of 4,200 or 4,300 on the upside are all realistic. What's interesting about that 4,000 level you were talking about, though, Nick, is that that 200-day moving average, which on page 4 I have on there, is just below 4,000. And that has so far held almost the entire 2023 price action beyond a very short blip in March. And I think it will be a real pivot in the bigger picture, that if there was another major sell cycle and spike in volatility, it probably is going to be under that 4,000 level where things will really start to pick up. Nonetheless, let's touch on the Qs. What are you looking at the levels for NASDAQ?
Spot right now on NASDAQ, the Qs is 315 approximately. Right now we have an implied move, again, for the April 21st OPEX of about 11 points in either direction. So upside of 326, downside of 304. Heavy put wall at 270 and a heavy call wall at 350 right now. Key resistance on the upside is 320 and key support right now is 300 on the downside. Again, I'm inclined to think we see some bullish momentum in the short term, and in the midterm, probably a test of the lows perhaps by September, October or so. But interesting to note that certain names are outperforming. Like, for example, right now, Google has released news in the past couple of days that depicts that their new supercomputer is more powerful than NVIDIA's with respect to AI and more energy efficient. So that could be a bullish catalyst in the short term. So what I'm looking at is being long specific names like Google, for example, or Microsoft, and then perhaps looking at being a bit more bearish on the overall broad market, that being the Qs. Nonetheless, I do see us hitting higher highs in the short term, but I do see us also hitting the lows in the next few months as well. So bullish in the short term and bearish in the mid to longer term, I would say.
Yeah, it's interesting when I have that chart here on the NASDAQ on page 6, it's been above its 200-day moving average and the relative strength has 100% been there. What's actually interesting, which I didn't have the chart up, was when you look at the Russell over NASDAQ ratio, and it really just shows how small caps have massively underperformed. Obviously, the Russell 2000 just packed with a bunch of regional banks, which has been a huge drag. But you're absolutely right about the fact that the leadership has been in the FANGs. The financials continue to lag. Even the big money center banks have barely rebounded from the banking crisis. And so I would agree that if the market is going to go a little bit higher, a lot of those tech names are probably the ones that are going to continue to contribute to the indices on the upside, and the laggards are probably going to continue to lag. Nonetheless, what's interesting on page 7 here, Nick, is that volatility, we're right at the bottom of the range again. And, I still view this that we're in a bigger bear market, and this is more or less some degree another bear market rally. And so I find it hard pressed to imagine volatility going back to 2021 lows where we were down at 14 or 15 handles on the VIX. Nonetheless, we're at this key support line, but we could stay down here for a while, right? Like what are the kind of levels you're watching here?
Well, looking at the VIX right now, we're hitting almost year lows right now. And it's interesting to see because last week we had that crazy rally on Friday into close. That was due to gamma positioning in the option markets on SPX primarily. But right now, as I've said in the past, seeing this reversion to 0 DTE options versus a 30 DTE average options, the VIX isn't as meaningful as it once was, perhaps. And so, with a VIX of around 20 or so, we see, we're expecting about 1.25% broad market moves each day. But we can stay suppressed and see intraday moves that are much larger. Obviously, in the last few days, we've seen very suppressed moves. But last week, we had a rally the last 3 days of the week or so. This week, we've been kind of muted, staying in a very tight range. And with the VIX over here at 1920, it's unlikely we're going to see a huge move in the markets. Again, news could change that, right? If we get some piece of news that comes out of left field, we could see a huge spike in the VIX and a corresponding decline in the broad markets. But for now, again, it seems like it's calm waters before the storm. Now, over on page 8, we have the US dollar index. Eric, what's your thinking here?
Well, it's tempting to say the dollar is trending lower if you look at the chart, but we're still within the consolidation zone. We would need a new daily close below 100 on the Dixie in order to really seal the deal on dollar weakness and show evidence that a new downtrend is really in play.
It's interesting for me, Eric, because as we approach the bottom end of the year range, which is more or less around this 101 level, the dollar weakness is still prevailing. But in my mind, I'm not so convinced that there's another nasty leg lower in the dollar yet. I mean, anything is possible over a long enough time period. But my current speculation is that even if we temporarily break down to 100 on a temporary basis, it would resemble potentially something very similar to what happened in crude oil going down to 65. It rapidly reverses and comes to the top end of the range. My thinking really is that the dollar is far more likely to be range bound in this 100 to 105 range in the coming weeks or month. And the next really big currency move will probably come in the summer going into the third quarter, where we could potentially be seeing a economic recession confirmed, and potentially a dollar could even act like a safe haven in that period. That's going to be really interesting to see.
Now on page 9, we have gold futures, which are now hitting almost all-time highs. What's your thinking here, guys?
Well, there's plenty of progress for gold bugs to celebrate, but the question becomes, okay, now what? We're flirting with channel resistance. The top of the trading channel is at about 2054, 2054. I'm looking at 2038 as I'm recording, so we're just a little distance below that. And just slightly above that, between 2060 and 2080, is the range of very heavy overhead resistance coming from the highs in 2020 and 2022, with, of course, 2020 was the all-time high for gold. So the question becomes, are we going to just punch through it? Seems to me like we're overdue at this point for some kind of a pullback or correction. We've got plenty of room to go to the downside. We could get all the way down to 1900 without invalidating the uptrend that's in play here. And it does not seem sensible to me to expect this rally to continue on its recent rapid upward trajectory. When we're already at the top of the trading channel, it's about the right place for a rollover to happen, and we've got major overhead resistance just above the market. If we could somehow rapidly power through that resistance and get to new all-time highs, that would be incredibly, incredibly bullish. But I think it's much more likely that we will get to new all-time highs, but maybe not till this summer sometime, and maybe there's a fair amount of consolidation ahead of us in order to get through what is a very, very significant resistance level just above this market.
Yeah, Eric, when listening to Adam, the potential of a really big gold move in the remainder of the decade is certainly possible. I'm looking at it far more tactically, although I feel that this run on gold has been really bullish and really nice. The one thing that I'm really trying to think through is, are we getting a little ahead of this too early? Overall, I think we could have a scenario where when liquidity starts to strain the markets, that gold could still throw back at some point, and that it's really in the post period where the Fed is starting to legitimately ease, and there's some liquidity coming back in the market where the really big push in gold can happen in the latter part of the year. So as we approach these all-time highs near 2100, while it's certainly possible that we poke above that overhead resistance, I still think that the really big move in gold is probably going to be later in the year, and that at some point here, gold is likely to pause and backfill. I wouldn't even want to call it a sell-off, but I think that it's going to not be a straight line up from here. So I just wanted to touch on that 10-year Treasury yield on page 10, and simply we had a major support line between the 340 to 350 level, and now we've had the yields break now down to new fresh lows for the year, and we haven't seen these kind of levels since September, and it really comes to the back of weaker jobs numbers that are starting to show the economy slowing, which certainly has a disinflationary impulse that has many bond bulls getting excited. It'll be really interesting to see see whether or not we see the 3% level in the coming weeks.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.